Recent question from a fan: what's a good low-risk investment for my Roth IRA? I've got that answer and the complexity that it creates. That and more coming up. My name's Mike Bernard. I'm the host of The Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. Love the Roth IRA, love it, but love financial planning more, comprehensive financial planning. And when you look at your present financial position, protection planning, tax planning, investment planning, retirement planning, and estate planning, those are the 6 areas of your financial life. As you're looking for solutions to bring synergy to your goals in each of those 6 areas, Roth IRA can make a ton of sense. Got a question recently from a fan of the show that normally we add to our queue for our weekly talk show where we hit those there, but it's so good and there's some depth to it, so wanted to hit it here. Here's the question: as a 60-year-old beginner, what's a good low-risk investment for my Roth IRA? Love it. Love the question. Again, at the surface seems simple, which I'll address, but there is some depth to it. First, what do I love? I love that even at that stage of life, any stage of life, you're wanting to save. And even as a 6-year-old beginner, yes, it's not too late to start saving. And second, I love that you're saving into the Roth, that you're looking at the Roth. Make sure that you're working with your CFPs so that you know, yeah, the Roth is the right account. Don't get the tax benefits today, have this money grow tax-free forever, or pre-tax. You might be in a situation, if you're starting anew and depending on your financial goals, where you're going to have enough Social Security income, and then to supplement Social Security, if it's this account, you might be in a spot where you're not going to have to pay tax on your Social Security, and when you add your standard deduction to offset any other income you have, you might be in the 0% tax bracket. So don't miss out on the opportunity to save some taxes today and then withdraw them out there in the future paying no tax. So work with your CFP on that. But assuming that the Roth IRA is the right choice for you, what's the issue? Because I love it, and I'll talk through and share some potentially low risk investments, but there's conflicting priorities here. As a new investor, I get it. You don't want to gamble. You don't want to be speculative. And at 60, you could even argue a lot of this money isn't necessarily long term. Some of it you might use in 5-8 years, something like that. And so maybe I shouldn't be taking a lot of risk, but that is at odds with the purpose and the structure and the tax benefits of a Roth IRA. See, the Roth IRA, as you contribute, there's no tax benefit on it. Okay, it's after-tax money that goes in. You would then invest those dollars. We'll talk about that in just a second. All the growth or dividends or interest on that, it's all tax sheltered. So the growth grows, accumulates, tax deferred. And then once you've had a Roth IRA for 5 years, that's another reason, forgot to mention that I love this, get that 5-year clock started. Once you've had a Roth IRA for 5 years and have reached age 59 and a half, you've got to have both of those, then the growth you can withdraw tax-free. Your contribution amount, you never got a deduction in the first place, so when you withdraw that, that's not taxable. So where's the tax benefit with the Roth IRA? It's on the tax sheltering of the investment activity, but then on the tax-free growth of the account. Therefore, that can be at odds with the idea of having a low-risk investment, because low risk often means low growth potential, which in the case of the Roth, low tax benefit. Again, assuming that you've worked with your CFP and the Roth IRA is the right way to go, what could you do? Well, if you're looking at the low-risk spectrum and you were saying, nope, my risk tolerance, no matter what the situation, is low risk. I do not want to worry about the stock market. The fact that there could be any ups and downs at all would cause me great concern and distress. And so if I have to invest it, I'm not going to fund the Roth. Even putting it in a savings account, if you could, well, money market or CD, if that can earn you right now 4.5%, 5.5%, I'd rather you earn that 4.5%, 5.5% in a Roth IRA, because you'd earn that tax-free. It wouldn't land on your tax return. So if you are truly low risk, work with your CFP, confirm that, and then invest in that money market, invest in that CD, invest in that fixed interest investment inside the Roth so that 4.5% to 5.5% will be tax-free. But beyond that, if you're comfortable, if you say, well, no, I guess it doesn't need to be that low of a risk, but how about some investment that's still low risk, but is appropriate for a Roth IRA where I have some more growth potential and can achieve more of that benefit the Roth provides? Well, I would consider hedging. There's a few different strategies out there where you can invest in the S&P 500, but with some hedging. JP Morgan has some great tools on that, and some others as well. Work with a certified financial planner. There's a lot of these out there right now, and you want to be very careful in your selection process, but something where you are investing and can capture some of the upside of the markets, but have some defined downside protection. My guess is that's what you mean by low risk. So those tools are out there. Work with a certified financial planner. Next, maybe what's appropriate is more of a balanced fund. There's a plethora of those out there, from Vanguard to American Funds to Fidelity. You've got to figure out which one's appropriate for you. These do take risk, but on a relative basis, and compared to just investing in the markets or a diversified portfolio, this one balanced fund is pre-diversified for you based on that manager's strategy and investment criteria, but tend to have less volatility than the overall markets, still strong performance. So maybe a balanced fund is more appropriate. And then finally, instead of just picking one fund and having that do the allocating itself, diversifying itself, maybe you pick a 60-40 type portfolio or a 50-50 type portfolio, something where your CFP, your investment advisor, is selecting the right large cap, the right mid cap, the right small cap, the right international emerging markets, and the right bond investment, short term, intermediate term, and so on. And so they're managing the diversification for you. I would consider, because of that diversification and picking one that doesn't have the majority in stocks, or maybe up to 60%, I would consider that lower risk, but still have some growth potential. You will see volatility, some ups and downs, but have some growth potential that would capture that benefit that the Roth IRA provides. So those are a few ideas for you, but it's not advice. You need individual investment advice and strategy from your CFP. And even before that, you need to confirm that the Roth IRA is the right type of account to contribute to. Your CFP doing comprehensive financial planning, understanding your tax picture, and doing that multi-year tax projection out there in the future, they're the only ones that are going to be able to help you confirm that. So work with your certified financial planner on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or send us an email, info@Korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.